Hi everyone, this is Dr. Sriharsha Devireddy, consultant radiologist by profession and an option trader by passion. I have been investing in trading in the stock market since 8 years, and presently I am planning to become a SEBI registered RA, and it will take me around 2 to 3 years probably because I am from a non-finance background. So this is an introduction to future and options by me, and there's a disclaimer. So everything that is being taught in this video is not to be taken for buy or sell recommendation, and you need to consult your SEBI registered investment advisor, or you have to do your own research before buying or selling any stock or using any of the strategies that I'm mentioning in this. So first thing, let's briefly introduce you to future and options. So future and options are complex financial instruments. They are often called a double-edged sword because if you know how to use them, you can make a lot of money. And if you don't know how to use them, or if you misuse them, then you lose a lot of money. Okay. So what exactly are future and options? Future and options are commonly called F&O. They are financial contracts. They are used in the stock market and they fall under the category called derivatives. So why are they called derivatives? Because they derive their value from an underlying asset. That's why they are called derivatives. They are deriving their value from an asset. What does that mean? So for example, you bought a Nifty call or a Nifty future. Okay. And then if Nifty rises, then Nifty call or Nifty future will rise. If it falls, it will also fall. So it inherently doesn't have any value, but it takes the value from the underlying asset. For example, if Reliance, you bought a Reliance call or Reliance future, and then if Reliance share rises, this one also will rise. Okay. And there are currencies also, there are commodity also. If you buy gold future and if gold rises, this one also will rise. You can buy US dollar also. If you buy US dollar future, if US dollar rises, then this one also will rise. Okay. So what first we'll introduce futures. So what is the future? It's a contract. Okay. And it's a contract between two people to buy or sell an asset at a fixed price on a fixed date in the future. That's why it's called future. Okay. For example, let us take an example that you're buying Nifty future. Okay. And then you're at the end of October. So this is October expiry. So within 30 days, what you're saying is that you will buy it at 20,000, no matter what. Okay. So you can use future for both speculation, that means gambling. So you're betting that Nifty will rise, or you can use it for hedging. This is a little complex topic. Okay. So in graph, how will it look like? Okay. First, let us explain the graph here. So this is x-axis, is y-axis. Ignore this area and ignore this bar charts and all for now. So you're here. Okay. If Nifty rises, then you will make money. How you know you are making money? It's in green. So it means that there is profit. If it is red, it means there is loss. And see the x-axis here. So here you are seeing there is 25,000, 25,200, 25,400, 25,600. So it means that as you move towards the right side of the graph, it means that the Nifty is rising. If you're going towards the left side of the graph, it means that Nifty is falling. Same thing applies to Reliance or dollar or whatever you want. So basically, if you're buying a future, here we are buying a future. So what is happening is as Nifty moves up, I'll make money. So what did you say? You will buy it at 20,000, right? No matter what, at the end of October. For example, at the end of October, Nifty is here. Okay. And it is 40,000. What did you say? You'll buy it at 20,000. So you got 20,000 rupees profit. And then if it falls, then you will lose money. Basically, understand this. Whatever the definition is, it means that if you buy a future and if that underlying asset, it can be Reliance share or it can be Nifty or it can be gold, whatever it is. If you're buying here and if Nifty rises, then you will make money. If Nifty falls, you will lose money. Okay, this is buyer side. Now, what did I say? I said futures and options both are contracts. So it means that this agreement happens between two people. That means there is a seller on the other side. Okay. And how will the seller's chart look like? Let us see his chart also. Okay. So this is your chart. This is buy side and this is sell side. So how is this? How the chart looks for him? So for him, if Nifty rises, he will start losing money. Okay. And if Nifty falls, he will start making money. It for you bought a future. That's why you're in opposite, exact opposite to him. So basically, you will make money if Nifty rises. You will lose money if Nifty falls. Okay. How much ever amount you will make profits here, this much amount losses he'll be making. So his money will be transferred to your account. Okay. That's a future or a contract. In reality, what happens is, for example, if I'm a seller and I'm losing money, after some time, after 10,000 loss, I'll exit. Okay. And then some other guy will come and buy. And then that guy will start facing losses. That guy will exit. And then another guy. So in reality, how it happens is one guy will exit, another guy will take, another guy will take. So multiple traders will exit multiple positions, but these happen in microseconds. So there are multi-level software that happens, but for you, it looks like this. As it is rising, you will start making money. Okay, but in reality, what happens is multiple people will be exiting, multiple people will be buying. So many lakhs of contracts will be exchanging hands in microseconds. Everything happens here in microseconds with supercomputers. Okay, so in reality, what happens is if you buy a Nifty future and Nifty rises, you will make money. If you sell a Nifty future and Nifty falls, you will make money. Okay. So what are options? Now, option is also again divided into two parts: call option and put option. Okay. So these are also same thing. You can use it for speculation, that is gambling. You can use it for hedging, that is insurance, and you can use it for income generation. Three uses you can do. You can use it anyhow. That's what I said. Future and options both are double-edged swords. You can use them however you want. Okay, so to remember this analogy, previously when I started understanding call and put, so initially I had little difficulty. So I created an analogy for myself to remember back in 2019 around that time. So these are the telephones that we used to have back when I was a kid. So now we have cell phones and all. So how this phone works is if you get a call, you lift it, okay, up, and then once the call is done, you will put it down. Okay, so if you feel that a stock will rise, you can buy a call option. Okay, so call, a call came, you lifted it up, so stock up, call, and then you're putting it down. That means that the stock is falling. Okay, this is just to remember analogy. You can even remember like this is also easier. So when you feel like a stock will fall, you can buy a put. When you feel like a stock will rise, you can buy a call. Same thing for gold, same thing for shares. For example, Reliance, you feel like it will rise. Okay. Then you can buy a call. Or you feel Reliance will fall, you can buy a put. Okay. And then basically you can sell them also. Okay. Now future, forget about future. Now remember only concentrate only on call and puts. Okay, so when did I say you will buy a call? When you feel like the stock will rise, right? That's what I told you. So this is up arrow. So you are buying a call. What does buying in financial terms, in option trading term? It means that you are going long. When you say that you are going long on a stock, it means that you are betting that the stock will rise. Okay, and when you are going short on a stock, it means that you are betting that the stock will fall. This is called long. This is going long, and that is going short. Okay, so here, if you see, if you buy a call, what will happen? Not what will happen. If stock rises, then you will buy a call, right? And if you feel like the stock will fall, you will buy a put. Okay. And then you can sell them also. Now this will be exact opposite, diagonal relationship. Okay. So when will you sell a call? You feel that the stock will fall. Okay. So exact opposite. See the arrows here. So you can buy a put if the stock is falling, or you can sell a call. You can do both of them. And if you feel like a stock will rise, you can buy a call or you can sell a put. Both of these you can do. There is a little difference. Let us see the difference here. Okay. So first, let's understand the structure, x-axis and y-axis. Here, as I told you, this is Reliance. Okay. Here, see, x-axis. As you move from left side of the graph to the right side, the price is increasing from 1300 to 1400. So it means that in all of these graphs, the central lines means this is the price where you are at. Okay. And this is the profit and loss that are there. You can ignore this one. It's called option interest and open interest, sorry. And then these are bar charts. You can forget about them. And this SD is standard deviation, one standard deviation, two standard deviation. So forget all of them. Only concentrate on this blue line. Okay. And then this x-axis. Only these two you concentrate. So when you buy a call, what happens? If you are right and the stock rises, you will make money. Okay. And how much money you will make? The profit is unlimited. As much as the stock rises, that much money you will make. Okay. But if you are wrong and if the stock falls, you will have minimum loss. Okay. What is the loss? The loss is called premium. So to buy a call, you need to make payment called premium. Okay. And this break even and all, I explain the further videos. So for now, forget about them. For now, just concentrate on one thing. So basically one thing only. If a share rises or a if the share rises and you buy a call, you will make money. Okay. And then you feel like the share will rise and you bought a call and you are wrong. Okay. And then you will lose money. How much is the money? That is the premium. And it is fixed loss. Okay. You will not lose more than the premium. Never. Even if the stock goes to zero, your loss will be the premium that you paid. It will never go to more than this, 1 rupee more than this. Okay. Exact opposite is put. If you feel like the stock will fall, you buy a put, then you'll make unlimited money. As much as the stock falls, you'll make that much money. But if you're wrong and the stock rises, then you will lose money. But how much money you will lose? Okay, it is fixed. Fixed is the premium paid. Okay, so the amount that you use is called premium. Okay, and then this is the opposite side. This is called selling a call. So you sold a call. Okay, when will you sell a call? If you remember diagonal shape. So you will sell a call if you feel the stock will fall. Okay, you can buy a put or you can sell a call. So what happens if you sell a call and the share falls, you will make money. But here profit is limited. No matter if the stock goes to zero also, you will make only the premium that is received. Like I told you, both are contracts, futures and calls, everything's are contract. So it means that when you are buying, somebody is selling. When somebody is selling, you are buying. So there is a contract. And here to buy or sell a call or a put, you have to use premium. That is the amount that is cut from your account. Okay. So here, but if the stock rises above, then you'll start losing money. Okay. So let us understand it in a different way. Okay. So there are multiple, this is a Reliance chart. Okay. This is x-axis, this is y-axis. Here we can see there are multiple prices, right? So it means that if Reliance is rising, you can see the price rise here. So when you go from up to above, it means that the price is rising. It means that when the chart is showing like this, it means that the Reliance price is rising. Okay. And this is x-axis. This is the time axis. And this is the price axis. Okay, so there are multiple strike prices. For example, if you want to buy a call or if you want to sell a call, you can buy or sell in at any strike price. What does strike price mean? So, for example, here there are multiple prices, right? You can sell or buy any price. So this is called option chain. So here you can see there are multiple strike prices. So you can sell or buy any call you want. Okay, they are called in the money, out of the money. But right now, you need not worry about those. Right now, just concentrate. For example, let us say that here I am selling 1370 rupees. Here, okay, let us say that I am selling 1420 call. Okay, so what does that mean? I'm drawing an imaginary line here. Okay, as long as Reliance stays below this line, till when? Till the expiry, 28th October. Okay, so till 28th October. And what did I sell? Which call did I sell? I sold 1420 call. Okay, for example, 28th October, 1420 call I sold. It means that I'm drawing an imaginary line at 1420. So as long as Reliance stays below this level, I'll make the money. How much money I'll make? The premium. Okay, the premium which is paid by the option buyer. Like I told you, option has both call buyer and seller. So in this case, I am a seller. So how much money I'll make? I'll make premium amount. So Reliance can go up, can go down, Reliance can crash, Reliance can go to zero. Whatever happens, as long it stays below this line, I'll make money. And what will happen if it crosses this line before 20th October? Then I'll start losing money. How much money I will lose? As it goes, how much above it goes, that much amount I'll be losing. Shall we see in real life how that looks like? Okay. So here, so this is sensible chart that I'm using. And see now, as I'm dragging it towards right side, you can see the loss. See 10,000, 12,000, 14,000, 16, 18, 20,000, 25,000. So how much ever the stock price rises, that much amount you'll be losing. You can see I'm stimulating the fall. So how much ever the Reliance share price rises, if I sell a call, then that much money I'll be losing. On paper, it is unlimited loss. Okay. So same thing for put also. So when will you sell a put? You feel that the stock will rise. Okay, so this is the place we are at, and this is right side, this is left side. So right now this is the exact place where we are at, and if the stock price rises from here, you will make money. But how much money? The money will be the premium that the buyer paid. Okay, and then if you are wrong, and if the share price falls or the index falls, then you will lose money. How much money? Unlimited loss. Okay. However deep the uh, price fall, the stock falls, that much money you'll be losing. Same like call. So if you sell a put, it means like there is an imaginary line that you're drawing. Now this time not up, down. Okay. For example, I sold 1360 put. Okay. 28th October expiry. So till 28th October, if Reliance share stays above 1360, it can go up, it can go down, it can bounce here, here, here. It can do whatever it want. But as long as it stays above this 1360, till when? Till 20th October. That's the expiry. Okay. Then I'll pocket the premium that was paid by the buyer. Okay. So this is how it will look like. This is both are both we are doing when we are expecting the stock price to rise. Okay, both we are doing for the same thing. Final thing is, I believe that Reliance share price will rise this month. Okay, so for this I can buy a call or I can sell a put. Both will make money, but see how much money. For example, Reliance rises till 1480, I'll make 35,000 profit. Okay, in buying a call. But if I sell a put, I'll make money, but how much money? 12,000. Okay, so and there is again the cost component. So I told you have to buy you have to pay a premium, right? So here, if you want to buy a call of Reliance, you need to shell out 17,950 rupees. This 17,950 rupees is the premium that you are paying. To whom will this premium go? This premium goes to the seller. And then what happens here? It won't go directly. There again, I told you it's a multi-segmental process. So, for example, I bought Reliance share, okay, and then it starts rising. Then I'll start making money. And then if I am wrong, I'll start losing money, okay. But the loss is limited. How much loss? 17,950. Okay. So the maximum loss that I can face if I'm wrong is 17,950. But if I'm right, I'll make unlimited profit. Okay. And then what are the funds needed to execute this? So if there is 17,950 in my Demat account, okay, it's not like you'll transfer money from your bank account to your Demat account. And if I have 18,000 in my Demat account, then I can execute this. Okay. But the same thing, if I want to sell a call, both serve the same purpose. They make money when the stock price rises. Okay. For to sell a call, to sell a put, sorry, sell a put, I need 1.2 lakhs roughly. Okay. And then this is again is this changes. Okay. For example, if instead of rising, if it starts falling and you're losing money, then broker will start for more and more. He will change this. It is dynamic. It can go to 1.4, 1.5, depending on the loss. This number will be adjusted. And if you don't provide the amount, then the broker will close off that position in loss. Okay. But here, if you have 17,950, you are done. It will never change. This is the maximum money that will be locked in your Demat account. So once you buy a call, what happens is this money gets locked. Okay. And then at the end of the month, if you are in profit, then this entire thing will be closed off and this money will come into your account. Okay. And here also same thing happens. This money will be locked. Okay. And if you are right and you make some money, maximum money you will make is 14,000. That's the maximum you can make. So this 14,000 at the end of the month, the 28th October, this 14,000 will credit into your account. Okay. And then they will release the margin. Now you can use the money also. Here the money that will be locked is 17,950. Here the money that will be locked is 1.2 lakhs. Okay. At the end of the month, they will release the margin. For example, here both are in losses. The maximum money will be 17,950. That's the locked amount. This entire amount will be debited from your account. And then here, if it goes up to 1.5 lakhs or 1.6 lakhs, then you have to keep adding margin, margin, margin. Finally, they will remove that 1.5 lakhs and they will, whatever money is remaining, that will be unlocked. Okay. For example, if they lock 2 lakhs and their loss is 1.5 lakh, then they'll take that 1.5 and 50,000 will be unlocked. Okay. And the same thing for put, opposite direction. You feel like the stock will fall, you can buy a put and the profit will be unlimited. However deep the market stock falls, that much money you will make. And you can sell a call also. They serve the same purpose. They make money when the underlying asset falls. But here the profit is maximum profit is 17,950. Okay. And the maximum loss is unlimited if you are wrong. Here you are wrong, you will maximum lose 14,500. Again, margin requirement is there. Even for selling a call, you will need 1.2 lakhs. Okay, and this is dynamic. Here, this doesn't change. 14,500 they will lock from your account, and that will never change. It will always be 14,500 only. By month end, this will be released. But by month end, this will be also released. Okay. So now you heard everything. You heard about buying and selling, buying and selling. Which is attracting you more? Is buying attracting you more, selling attracting you more? Okay, see how there is unlimited loss if you are selling side, and if you are on buying side, there is unlimited profit. So most people go for buying. Okay, so to demonstrate all this stuff, I'll be using Sensible software. Okay, this is not sponsored video. I have been using Sensible since, I don't know, since its inception, many years back. Back then I used to pay money, 10,000 rupees or 12,000, I don't remember, per year. And now with Zerodha, it is free. Okay, and it has come a lot. So let's understand the structure again. So this is x-axis, this is y-axis, and this is showing the profit and loss. So right now you are at no profit, no loss. If you are right, then follow the blue arrow, you'll be start making money. This is call. If you are wrong, you'll be losing money, which is limited. Okay, by now, multiple times I've explained to you. So by now you understood how this works. Okay, so now let here. Now we are going, we are checking the Reliance, and then we are buying a call. What is the strike price? We are buying it 1380. And what is the amount that is required? 17,950. That is there. Then I can buy. Okay. This should be not in bank account. This will be in Demat account. It's very easy to transfer the money. But once that amount is there in the Demat account, and then I'll buy. And then if stock price rises, I'll start making money. If the stock price falls, I'll start losing money. How much money is the money that I'll be losing? Limited loss, unlimited profit. So most people are attracted towards buying. Why? Because they feel like they will because there is less to lose, right? There is less to lose. See, I'm bringing it so much down, but the loss is fixed. It won't go beyond 17,950. Now there is this guy. He has two options. He has 50,000 rupees with him. He has two options. He can buy Reliance shares, or he can buy call option. If he wants to buy Reliance shares, he has to buy using entire 50,000. Or he can buy using only one third of the amount, he can buy call. Let us see, he has road not taken. So he is split here. Now let us take both decisions, and let us see what happens. Okay. For one instance, for one point, we'll see Reliance, he bought using cash. Okay. So he has 50,000 rupees cash with him, and then he bought Reliance shares. And then Reliance shares, for example, moved 100 rupees. Okay. And then how many shares you will have? So currently the market price is 1,363. So you are investing how much amount? 50,000. So 50,000 divided by 1,363, you get 37 shares roughly. Take it as 36 shares. Okay, roughly you are getting 36 shares. Okay, and then how much price did I tell you that the Reliance share rose? It rose 100 rupees. Okay, so how much are you making? You are making profit of 3,600. How did you get this 3,600? All the calculations are there here. 36 shares you have, right? 100 rupees there was. So 36 into 100, 3,600. They made all the calculations. I made all the calculations to show like the price and all. But finally, what happens is you have 36 shares of Reliance. You use 50,000 rupees for it. And then what happened? Reliance share was 100 rupees. And then how much? Each share will rise 100 rupees. So how many shares you have? 36 shares. So if one share rises 100 rupees, 36 shares will rise 3,600. So what is the profit that you made? 3,600. How much money did you invest? 50,000 rupees. Okay. Now the same thing, let us see. Okay. So what did I do? I bought Reliance call using how much money? I told you 17,000 or 18,000, something like that. And then I bought the call. And then here, 100 rupees. Same thing happened. I have entered here. See, in Sensible, you can enter the price and it will show what is the profit that you'll see. It is 40,000 rupees. Okay. He made 40,000 rupees profit. If the Reliance same, it rises 100 rupees. But with Reliance share, how much did you make? 3,600. Here he made 40. Okay. And then if he was wrong, he would have lost only the premium. Okay. The maximum loss he would have faced is 16,000. But here, if Reliance share falls very heavily, then that 50,000 may go up to 20,000 also. Okay, we cannot tell till how much Reliance share will fall. Okay. So both instances, understand. With profit, The profit that was made on call was 40,000. Here it was 3,600. And he used 50,000 rupees for buying shares. Here he used only 16,000. And on 16,000, he made 40,000 rupees profit. And by buying using cash, he made by using 50,000 cash, he made 3,600. And then if he was wrong, for example, instead of rising, it started falling. How much money he will lose on this Reliance call? He will lose only 16,000. Here, we don't know how much ever Reliance share will fall, that much amount he will lose. For example, there is 50,000 rupees here. By here, I think he'll have around 30,000 rupees. So 20,000 loss. Or it can be more also. It can be 40,000, it can be 50,000, it can go, he can lose the entire 50,000 also. Practically, it is not possible, but theoretically, okay. Here he will lose only 16,000. Okay, so now let us see both scenarios. So here he invested call option and then he made profit of 23,600. Okay, and then here, and if you lose, if you are wrong, you will lose the premium. Here, how much ever the stock will fall, that much. So, theoretically, on paper, you can lose the entire amount. On paper, theoretically, you can lose the entire amount also. Okay, and here, how much profit did he make? 3,600. So let us see return on capital. Return on capital invested means how much money you invested, how much return you got. Okay, so for this, you invested 50,000 rupees. For this, for buying the shares, you invested 50,000 rupees. But for buying the call, you invested only little amount. You invested one third of that 50,000 rupees. So you can buy three calls also, but this fellow bought only one call. And then he made 253% return on capital. And this guy made 7% return on capital. Okay, let us assume that there are two guys instead of one guy, and then one guy invested in shares, one guy invested in call, and then look at both of them. One guy made 7% return, one guy made 253% return. So now, what looks attractive to you? Okay, everybody will feel attracted towards the call option. Okay, why? Simple mathematics. I'm investing this much amount, I'm getting this much return, and I'm investing this much amount and I'm getting this much return. And then if I'm wrong, I'll be losing. Theoretically, on paper, I can lose this entire amount. Here, I can the maximum I can lose is 16,000. And then I can buy call again. Then I can buy call again because I can buy three times because I have 50,000 rupees. So 16 threes are 48. So three times I can buy a call. Okay. So which looks attractive to you? Does cash look attractive to you or options look attractive to you? So anybody will get attracted towards options. Okay. So the problem with options is not the profit or loss. For example, if that guy was right, okay, do you know what he'll get? He'll get money and then he'll get one dopamine hit. Okay. So one dopamine hit and one money. And then what happens? You win a trade, you get one dopamine hit, and then you win multiple trades, you get multiple dopamine hits. That becomes an addiction, and then you'll crave more, and then you'll try to win trades. Okay. Finally what this converts into? It converts into this. These are actual messages that I have taken as screenshots from Reddit. So I'm part of multiple Telegram groups and Reddit groups for investing and trading. So lost 45 lakhs in options, and this guy even took loan. This guy lost 1.2 crores. And this is not just limited to India. Okay, even in US, there are this guy lost all hope, and he lost 350 dollars. There are multiple scenarios. Okay, it's not just India or something. Okay, and then this is an article by Times of India. Okay, so if you are interested, you can read this article. I'll be showing the link also. So this is called something called beginner's luck. This happens to all. This happened to me too. Back in 2020, this happened to me. So basically, whenever a newbie enters future and options industry, what happens is you'll make a lot of money initially. I don't know why. Anybody who enters, they will make. So this guy on Bank Nifty, okay, I told you there is Nifty, Bank Nifty. So this guy bought Bank Nifty weekly expiry. He converted 3,000 into 30,000 in half an hour. Okay, and then by end of the day, he 8.75 lakhs. Imagine the dopamine hit that he'll get. So the problem is, if he had stopped here, he would have 8.75 lakhs. But once you start making that money, your behavior changes a little bit. So only few people can like stop here. So what they do is I converted 3,000 into 8 lakhs. So what they feel is like I'll convert this 8 lakhs into 1 crore and I will settle all my debts. So that's the problem with F&O. So man, that high while doing the first trade was fantastic in the very first go. Okay, he doesn't know anything. He just thought, okay, Bank Nifty, I think it will go up, and this is Chirag, and then he made profit of 12,000. Okay, So sitting on the computer and making money, this changes you mentally also. It's not like future and options or something. Anything that you do, Dream 11 or any gambling app or anything something. So when you sit on the computer and make money, so it's completely different from your job, right? In job you have to sit, you have to work, you have to listen to people shout at you, and then everything happens, and then you make some money. And imagine if you make 3 or 4 lakhs from 40,000 or 50,000. So that high that you get, that's difficult to break into. So see, this is the actual study, okay, conducted by SEBI. Who is SEBI? SEBI is the policeman of the stock market. Okay, I'm giving a like an analogy. Okay, so they track the entire data. They are the people who control like everything in the stock market. So that is SEBI. Like we have police, right? Control the crime and all. So in the stock market, we have SEBI, and SEBI studies everything, and they try to limit. They created multiple things they have done to prevent retail traders. We are retail investors and retail traders. So according to their study, see, despite the high likelihood of losses, many traders find it hard to stop. You know why? Because you're not just making profit. Everybody thinks that you're making profits in future options. You're hitting the dopamine level too. Okay. And SEBI study reveals that 75% of loss-making traders will continue trading in F&O even after facing consecutive years of setback. Not this year, maybe next year, maybe next year, maybe next year I'll make money. Because I made money some or the other day, I made 8 lakhs, I made 12 lakhs. Okay. So Punit Sharma likens this behavior to gambling addiction. Like gambling, trading F&O also can trigger an emotional response that is addictive. Okay, and the traders continue to place bets in the hope of recovering losses. This is called gambler's fallacy and overconfidence bias. Oh no, okay, I made money. I'll keep making money. Okay, these are actual terms, and these are actual things that you'll experience. Okay, unlike equity, share market, F&O instruments are have to be settled on their expiry day. I told you. So it's a zero sum game. One guy loses, one guy makes money. So this is the article. If you're interested, you can read this. India Today, special story on future and options. How much money you are losing. Okay, this is again by SEBI. Okay, this is actual data from all the brokers. Okay, if you want to trade or invest in the stock market, you have to go through something called a broker. Your bank can be a broker, Zerodha can be broker. There are multiple brokers, Grow, Zerodha, Upstocks, multiple brokers are there. Okay. And then from all the brokers, finally, and from NSE and BSE, SEBI has taken the data. Not just 1 year, multiple years it has taken data. And according to the data, 93% of traders lost money, averaging 2 lakhs per person. Only 7% made profit. Okay. In that, only 1% of traders made profits exceeding 1 lakh. Okay. So this is not just 1 year data. This is multi-year data from multiple brokerages and exchanges. The official data this is. So 93% lost money and only 7% made profit. In that, only 1% of traders made profit exceeding 1 lakh. Okay. So what's the problem with future and options? It's not understanding what they exactly they are. Okay. For example, you don't know how to drive a car, and then you sat in the car and pressed on the accelerator. What do you think will happen? So what you need to understand is, I keep telling, right, future and options are contracts. They are between two people. Okay. So what exactly do I mean by contracts between two people? I told you there are buyers and sellers, right? You know how many contracts are traded every day? 8.5 million contracts are traded daily. That's why you won't see that contracts getting exchanged. It happens in microseconds. Okay. There is broker, there is national stock exchange. There is a lot of things that happen in between. And then totally every day, 8.5 million contracts are traded. It means that between two, between multiple people. Okay. So 22.17 lakh crore turnover. Okay. That's the notional turnover. It's again, this is a little complex, but understand that this much amount is exchanging hands. Okay. And then what you need to understand is, what do I mean by I keep saying contracts are between two people, right? So if there are multiple people who are ready to buy and sell, buy and sell, buy and sell, then you will see that the prices are perfectly framed. For example, I told you this is the option chain, right? So this is call. This red color areas are call, and this green color areas are puts. Okay. So right now we are at 1360. Reliance is at 1360. And if you see left side, if you go, you're seeing call price. This is the call price, 36 rupees. Okay. And this side, if you go, it is 15 rupees. Now you see a pattern here. See that this is in descending pattern, and here it is ascending pattern. And everywhere there is no problem in buying or selling. You know why there is no problem in buying or selling for 28th October expiry of Reliance? Because there are people who are present. There are multiple people selling and buying. That's why you are not seeing any gaps here. For example, let's come to IDFC Bank. IDFC Bank also has future and options, and you can also buy calls and puts of IDFC Bank. Here you are seeing dots. So at this particular price, you cannot buy or sell. Why? Because there are no buyers or sellers here. So it means that for a contract to get executed, there has to be liquidity. What do I mean by there has to be liquidity? It means that there have to be buyers and there have to be sellers, and they have to be in million. Like the contract should be in million people. Then only you will see. See here, there are no dots here. There are no blanks here. So IDFC Bank, if I want to buy 75 rupees put or call, I cannot buy. Why? Because there is nobody buying or selling here. Even here, this liquidity is very less. See, currently it is at 68 rupees, IDFC Bank. 67 rupees, 66 rupees also, there are no buyers or sellers. Okay. So that means one thing. It means that there is, unless there is a buyer and there is a seller, then the contract won't happen. Okay. Here maybe buyer is missing or seller are missing. One of them is missing. That's why I'm not able to buy 64 rupees of IDFC Bank. So why I keep stressing buyer and seller, because what you need to understand in future and options, main thing is it's like a chess game. Okay, between buyers and sellers. Okay, for example, let us assume that you are the buyer and this is the seller. Now you need to understand who are these people. Who are these people who are ready to sell for unlimited losses? Like I told you, in selling you can sell put or you can sell call, but the main thing is they'll make limited profits but unlimited losses. So these are the sellers of the Indian stock market. Okay, they are called option writers. Okay, I taught you some terms, right? Going long, going short. So going long means that you feel the stock will rise. Going short means you feel the stock will fall. Okay. And when I say option sellers, they are called option writers. And who are these option writers of Indian stock market? Domestic institutions like mutual funds, insurance companies, and there are foreign institution investors also. They are called FIS. These are the main guys. Okay. In Indian stock market, these people do very less F&O. FIS do a lot of F&O. Okay, they often write options. They do it for a separate thing. They generate separate steady income. I'll explain it later. And there are hedge funds and proprietary trading firms. These guys are very dangerous. These guys, they use very complex strategies. Okay, spreads, arbitrage, and volatility trading. Uh, I'll tell about these guys next. Okay, and there are HNIs and professional traders, and there are market makers and brokers also. Okay, all of these guys are sellers of options in market. Okay, and who are these guys? Mostly these are us retailers. Okay, but nowadays even retailers are selling. Okay, so now let us say, why do they sell? Why do these people sell? Okay, for them they collect the premium. For you the amount is less, but they do in lakhs of crores. Okay, so that amount translates to lot of amount. If you want to sell one call, how much money you need? 1 lakh. And how much maximum profit you'll make? 12,000 or something. Okay, so on 1 lakh you're making 12,000 if you are right. And if you are wrong, again you lose money. But for them, they have around 1 lakh crore, 2 lakh crore. They manage 12, 13, 14 lakh crores. Okay. And then they will sell. For you, the premium will be less, but for them, if you sell 1 lakh crore worth calls, imagine how much money you will make. Okay. And then statistical advantage. Most retail traders, they try to buy options. This is lottery mindset. What will happen? On maximum, I lose is the premium, but I'll make multiple profits, multiple amounts in profits. And then, since mostly they expire worthless, sellers often win. Okay, in reality, what happens is on paper, it looks like limited loss and unlimited profit, but in reality, sellers are the ones who often win. Okay, and then some institutions use for hedging. This is the one that I'll be teaching. Okay, so they hedge their portfolio by selling calls and puts. Now I'll explain. I told you I'll explain a little bit about this proprietary trading firms. Now, recently, one of these proprietary trading firms has been caught by SEBI. Okay. and why Jane Street, a US trading giant, is in trouble in India. You know what they did? They manipulated markets. What did they do? So they divided the day into two parts. First morning half and second half. Okay, so in morning half, what did they do? They started buying shares. And then what happened? This when you keep buying shares, what will happen? That, for example, let us take Reliance. Okay, they started. This is only for example. Okay, so what did they have? They'll have lakhs and crores of rupees to buy and sell. So what did they do? They bought 100 crore worth of Reliance shares. Now, what will happen if you buy 100 crore worth of Reliance shares? Reliance share price starts rising. Once it starts rising, retail traders will start noticing this, and they will also come and start buying. So, for example, with 100 crores, they pushed the Reliance share from 1,000 rupees to 1,500. Retailers will come and push it to 2,000 rupees. Okay, this is morning half. Now, second half, what they will do? They will do two things. First, they will sell call here. I told you you can sell at any price, and then as long as it stays below that line, you will make money, right? So, where did the Reliance share go? It went up to 2,000, right? Now, first, what they will do? They will sell that call, 2,000 rupees in the afternoon. Now they have shares, right? 100 crores worth shares. Now they will sell in profit. Okay, they bought at 1,000 rupees and they sold at 2,000 rupees. They made 1,000 rupees profit. Okay, each share made 1,000 rupees. There are 100 crores. Okay, and imagine the profit there. And then they sold calls, right? Now, what will happen once you sell 100 crore worth of shares? The share price starts falling. Then retailers will panic and they'll sell it more. Now, what happened? On the expiry day, this call got closed. So dual money they made. This is one of the strategies. Okay, this is the first one. Index day manipulation on expiry day. Okay, if you do this on expiry day, you can make a lot of money. And then there are other things that they have done: pump and dump with options and distortion of index levels and structuring. It's little complex, but if you want, you can pause and read all of this. So these are the things that they have done. This is the one easiest to explain. So I'm telling you, like how if you have money, you can manipulate. So what did they do? They started buying shares and everybody started buying, and then they sold shares and they made money. Then they sold calls and they sold shares, and then once it started money started falling, they made again money. You know how much money they made? So like I'll show you for explanation visually. So what did they do? For example, let us assume that this is expiry day. Okay. So first, what they will do, they will start buying Reliance shares. Okay, and then it will start rising, 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 rising. From here, somewhere retailers will start noticing. Okay, from here they will start buying and they will bring it to here. Now this is afternoon. Okay, how much money they made? They bought it here and they can sell it here. Now first they won't sell. First they will sell call here. Imagine this line they sold. Okay, so this one they sold. Okay, next what happened? They will start selling their shares. Now the shares are in profit, right? So what will happen? They will bring it till here. Now Reliance retailers will panic and they will bring it to here. Okay. Then what will happen? They will make money on call. Why? Because today is expiry day. Okay. On the expiry day, you can manipulate like this if you have a lot of money. So they made money two ways. One is by shares in cash. One is by options. That is again in calls. And expiry day, if you do, then you can make more money here. Okay, first they will inflate the index, then they will build index shorts, and then you can do this index level also. So this is Nifty. Even Nifty you can do if you do a lot of buying and selling in the Reliance and HDFC Bank. You can move this also. So and then they unwound their long stock and future options. Okay, so again there is profit here. There is profit. Basically, they made profit on the stock rise and stock fall also. Okay, that is one of the things. So SEBI issued a warning to them, and then they banned them from trading. But then they paid a fine, and now I think they are back. As far as I know, they are back actually already. So on one expiry day, they made 735 crores. Okay, one day they made that profit, and then overall, you know how much money they made? They made 43,289 crores. They made. Okay, out of this entire fiasco that they have done, and after making this much money, I think they paid fine of this much or something, and then now they are back again. So first thing you have to understand is data is a privilege. Okay. The data that you can see, that is different from the data that they can see. Okay. For example, I'll give you an example of this book. Okay. This book is called Market Wizards by Mr. Jack. I used to read this book a lot, and then they made an audible book also. So you can listen to this stuff. So basically, what he does is back in 1990 to 2000, this guy went and took interviews of hedge fund managers. Okay. Right now, even if you want to talk to them, they won't let you talk. So this was back in 1990s. At that time, they used to talk. So he used to ask them, what are the strategies that you use to make money in the stock market? So one of the guys, he told a strategy. So what they do is they will pay money to the exchange, okay, and then the exchange will show where the retailers have bought the calls or where they sold the calls. Retailers also now started selling. So for example, you sold 1500 call, okay. So this data can be seen by them if they pay money. Okay, so this was one of the strategies that one of the guys he interviewed told. So they can see the so once it is at 1500, so retailers keep something called stop loss. So somewhere around 1600, the stop loss will be. So what they do is they start pushing the price, okay, till 1600. Okay, once it reaches 1600, the people who sold 1500 call, they'll start panicking. Okay, like, okay, I think I'm in loss and I'll exit. Okay, they'll exit mass. Okay, and then they went till the 1600, right? Now they'll start selling. Okay, they will sell calls here. Okay, this is one of the nice. There are multiple strategies that they use, but what fascinated me was one of the persons he interviewed told them that they can get data that is not available to us. For example, you and me, we cannot see where the majority of the calls and puts are. We can see there is something called option data chain analysis, but the data that we see is publicly available, right? But the data that is available to them is different from the data that we have. So they can see where we are all. So we are all using brokers, and finally it goes to National Stock Exchange, right? So that's how it happens. So they can see where the majority are, or they can guess also. It's not like this is one of the strategies. Nowadays, it has a little changed. Okay. So there are multiple layers to manipulate. Okay, first thing is this one. This is called order flow leakage. In reality, this is banned. Okay, this is banned. You are not supposed to share this data with third parties. Okay, the exchanges are not supposed to share, but some sort of order flow leakage happens. Not just in India, in entire world, this little flow leakage happens. Okay, and then level 2, level 3 data. The data that you and I have, the charts that you and I use, the indicators that you and I have, the option chain, there's something called option chain analysis. Okay, so using that you can guess, okay, this stuff. That but the data that you have is level 1 data. They can buy level 2 and level 3 data. Even if you and I want to buy, we cannot buy this. This is called market depth. Okay, they can see the market. For example, the market depth that you can see is up to 5. Okay, they can see up to 1000. So, and they can guess where the majority of orders are, and if they can just push till there, and then they can sell the call then. So first they won't sell call. Okay. So for example, I'll tell you in an easy way. So Reliance shares, nowadays retailers all started selling calls. For example, Reliance shares, retailers sold calls at 1600. Okay. Now these guys, they have not sold calls or anything. They just bought Reliance shares. Okay. And now they started buying at 1000 rupees or something. Now it is rising, rising, rising. Now, as it comes closer to 1600, retailers will start panicking. Now, slowly, they'll come and they'll see that majority of retailers are here. Then they will push the price to 1800. Okay. Now, all of these guys will panic. All of this will be at least 40,000 or 50,000 in loss. They will think, okay, now 40,000 loss is only there. If it goes above, I will lose money. So they will all exit. Okay. And then they may again do whatever they want to, but these guys know what they will do. Now they know that it is rising, right? So these guys who sold calls, they may buy calls here. Okay. Like because it is rising, they lost money in selling call. So what they will do, they'll exit their position, they'll buy call here. Now what these guys will do, they will sell 1900 call and they will sell their shares. So now they made money and now it is falling. They made money here also. So this is called behavioral clustering. Sorry, this is called market level data. Next, behavioral clustering is so roughly retail investors usually cluster around round figures. So, for example, round numbers. This is the areas where we try to buy or sell. There's something called behavioral clustering. There is a study on this. And one more thing is called open interest and option. I told you there are graphs here. You forget about them. So this is called option chain data. The option chain data that you and I see is different from the option chain data that they can see. Okay. And then, like I told you, some leakage of order flow happens, right? So there was one scam that SEBI detected. So this is called co-location scandal. If you want, you can see, you type in Google NSC co-location scam. You will understand how this one worked. Okay. This broker level visibility. I told you there are 4 levels to manipulate market, right? So this broker level visibility is explained in this NSE colocation scam. This is one of the scams that SEBI detected, and then this is a recent one. Okay, and this article is by Suchita Dalal. If you want, you can read. Suchita Dalal is the one who exposed Harshad Mehta scam, 1982 scam. I don't know if you have seen that TV series, a very good one. So that was exposed by Suchita Dalal. So once see this if you are interested. Okay, and then I told you there are multiple layers, right? So this behavioral clustering and then these three, they are done by nowadays by these people. Okay, they are called quantitative analysts. They are called quants. Okay, so who are quants? So what is their background? PhD in mathematics, physics, statistics, and they are from which graduate engineering colleges? Stanford, IIT, MIT, from and then finance schools. And then what are the skill sets that they have? They have this one. So I told you Jane Street, right? So Jane Street employs these people, and you know what their starting salary is? Okay, even some Indians get salaries. This is the starting salary for them. Okay, so they are employed in hundreds to thousands. Okay, by whom? By I told you there are multiple trading firms, right? I told you there are multiple trading firms here. Okay, hedge funds and proprietary trading firms. Okay, so these guys, these trading firms, proprietary trading firms, employ these guys in hundreds to thousands to develop algorithms. Okay, using all these things. So they develop algorithms, and then see they even have problem solvings, and then these are the guys you are sitting on a chess against. Okay, so don't think that these FIAs and trading firms they only do selling, they do buying also, because they understood that retailers are selling, so now they have gone into both buying and selling. They are doing both now. Okay, so for example, if you are the buyer, so the person who is opposite you, when I told you all the futures options, everything is contract. So it means that it occurs between two people. So on a chessboard, you're going against these people who quants. And who are quants? These are the things that they have done. And there are hundreds to thousands of them. And then in the world of future and options, these are the tools that you can use. Option strategies are the tools of the retail trader that you can use on the chessboard. Okay. So what are option strategies? In the world of future and options, they are the retailer's toolkit. They are a structured way to manage risk, hedge positions, and also to compound returns. So what you can do by using option strategies, you can repair a losing position, or you can change it into a profitable position, or you can close it in a small loss. Okay. In the next video, I'll be discussing the various option strategies that are available. And I'll also introduce you to cash hedged option trading strategies. Okay. These cash hedged option trading strategies, they work independent of market direction. Okay. So let's see you in the next video.